So why use superannuation to save for retirement? This tries to explain it from a tax perspective. So if you've got a chunk of money to invest, you can choose to invest it in your individual names, in joint names, so with your spouse, for example. You can invest in a trust, a company, in superannuation. And in superannuation, as we've talked about, there are two phases, so the accumulation phase and the pension phase. There are other types of investment structures as well. So there's insurance bonds, investment bonds, education scholarships and annuities. But the main investment structures that most people consider are really these five. If you've got a lump of money to invest, it either generates, for example, if you've got a fixed term deposit, then you'll get some interest on that money, or capital gain. If you have bought a painting, for example, and for $10,000 and you sold it for $30,000, you've made a $20,000 gain, and that's called a capital gain. And you could potentially pay tax on that gain. So the key thing that you need to understand when working out which structure to invest in is what your marginal tax rate is. Because if your marginal tax rate is anything above $18,200, any earnings that you earn are going to be taxed if you include the Medicare levy at either the Medicare levy is 2%, so tax thresholds are either 21%, 34.5%, 39%, or if you're earning over $180,000, there's a debt levy as well, so it's 49% tax rate for people earning over that figure. And you can compare that to investing it in joint names where you still might pay those figures. In a trust, sometimes it is beneficial to use a trust because you can distribute to charitable organisations or churches or other bodies. So there is sometimes it's valid to use a trust. You can use a company, but there's a flat 30% tax rate, and often we can get a better rate through the likes of a superannuation. In the accumulation phase of super, as we've talked about, the tax rate is 15% on income and 10% on capital gains if you've held the asset for longer than 12 months. So what this is trying to portray is that superannuation is generally a reasonable structure in which to invest because of the tax rates. There's a 15% tax rate on earnings, which is often better than your marginal tax rates. Or if you've reached a preservation age, you can pay 0% tax on earnings in that phase of superannuation. So it's a good vehicle in which to save for your retirement.